You know emerging market investment better than most. Give us your sense of where that is right now, because all we hear about is it's all about the United States, invest in the United States, the strength of the U.S. dollar.
Great to be with you, David. And of course, as our letter said recently, that U.S. exceptionalism or U.S. Dynamic investment theme is still going very, very strong. And that's really for no reason except we have great innovation in the U.S., we have great technology, AI, and then, of course, rule of law when it comes to financial markets. Emerging markets, where I have been investing for a long time, but I have worked in also during my days at the World Bank, I think are going through a phase where maybe we shouldn't even be using the term emerging markets because they've diverged from each other so much. Obviously, the big elephant in the room is always China, and that used to account for 40% of the EM equity indices. Today, it is accounting for only 25%. But what you're seeing through the same themes of American growth in our economy and growth in our equity markets, and this sort of term exceptionalism, if you want to call it that, is also impactful in emerging markets. If you go to Korea and Taiwan, which now account for 30% of emerging markets, they have done very well. If you look at Taiwan, whether you look at 1 year, 3 year, 5 years, 10 years, 20 years, it's always been very competitive with the US. But why? Because the goods that Taiwan has been producing, mainly microchips, have been something that has been very much part of this theme of innovation. If you go to India in the last 5 years, 10 years, similarly, the economy has done relatively well. Obviously, we had elections there recently, but the markets continue to do very, very well and sort of run between 9 to 11%, depending on which periods you are thinking about. And now with friendshoring, which is definitely impacting India positively, and other countries like Mexico positively, where our terms of trade with Mexico have changed. And Mexico, of course, is also benefiting from FDI for this friendshoring, as well as remittances from abroad. You see very different kinds of markets in the last few years in Mexico. So I think when you put emerging markets as one term and generalize, it hides the good, the ugly, and the in-between. And I think where things have not gone so well in emerging markets is where, for example, the continent of Africa, where we hoped for much bigger growth, parts of Latin America that are not necessarily commodity rich or very close to the US in terms of friendshoring, that have not benefited from these kinds of themes. And those countries have been left behind, especially since COVID, and dragged down the markets together with China, and drag down growth in these countries and the potential for their populations.
So that was a terrific laying out of the alternatives. If I can sort of simplify it a little bit, if this were a horse race, we've got some steady ones that have been investment destinations for some time, such as South Korea, such as Japan, such as Taiwan. You have India, which it sounds like is sort of an up-and-comer, as it were, and perhaps Mexico as well. Where would you rate this in the horse race in terms of the change in position? Which ones are coming up the fastest?
Well, I think definitely India is coming up the fastest, but also let's not forget, if you looked at India the last 10 years, the returns were really, really strong as well. Taiwan is the big question mark, given the geopolitics and its very, very rough location in the world, being right next to China, and if and when there could be a military threat there. And what is going on, despite that, is the fact that their companies are doing well by producing in Taiwan, but also now investing in the US and other locations to produce microchips. Obviously, they have not been as fast and as efficient as they would have liked outside of Taiwan. But I think that's a trend where we might see these Taiwanese companies continue to do well, but maybe not in Taiwan.
Afsaneh, talk about the role of currency in all of this, because obviously those are investments in different currencies. As I understand it right now, the Fed has been pretty dominant in terms of them setting rate policy, and that sort of determines the strength of the dollar. But when you talk about other currencies, when you invest in a place like India, for example, or in Mexico, how do you account for currency volatility? Do you hedge against that, and how expensive is that?
So two or three things. Obviously, with the really strong policies that Chairman Powell has had in the U.S., our economy has done well, but also our currency has stayed very strong. The interesting thing, as you said, is our currency has stayed quite strong relative to other DM currencies. We saw with the devaluation of yen and what the interventions in the recent weeks in Japan, still dealing with weaker yen than the Japanese government would like. Europe obviously is also going through its own relatively rough patches because growth has not gone up as much as they would have liked to. The emerging markets have been a really interesting spot. I think one thing that has happened in the last few years is that the quality of your central bankers has improved a lot in emerging markets. So you do have really good people running them. And you may remember before, in the beginning of the rate increases, they were maybe earlier than us in the US to increase rates. When they're more used to having these terrible inflationary periods. So when they saw inflation come, they increased rates earlier. And so when we look at their currencies, it is also a tale of two cities, where you see, for example, relatively, I should say, stronger currencies, again, in places like India, places like Mexico, places like even China has had, again, depending on which side of the ocean you're looking at. But then you have other countries that have not benefited, except for maybe some commodity-rich countries around emerging markets. Despite now two things about the currency factor. The currencies are stronger. That impacts more the bond markets. So you have seen bond markets in emerging markets over the last 10 years, the size has increased hugely, both local bond markets, where local people invest, as well as foreign markets. The emerging markets indices are close to now 3 trillion or thereabouts. So the size of these markets have increased, and people do look at currency very much when they look at them. We look at the bond markets. On the equity markets, currency has not necessarily moved the needle too much, except you could argue with outflows for emerging markets. Sometimes when their own currency is stronger relative to the dollars, you see more of an outflow. And last point I want to make on that is in China, where there has been very big outflows and people have maxed out to the amount they could to bring savings outside of China.
So do you spend the money to hedge when you invest in emerging markets?
Oh, sorry, I did not answer the hedging. Hedging is extremely expensive in emerging markets, yes, except for the much larger countries. Even there, the relative cost of hedging generally means that you don't hedge too much. So the cost, yes, generally makes it prohibitive to go into these currencies. And if the market returns had been so much higher than what has actually transpired, maybe you would have been okay with the cost of hedging. But given that their markets in general have been, if you look at emerging markets as a totality and you look at the returns, let's say over the last 10 years, and you are just up a few percent, that definitely does not cover cost of currency hedging.